Good evening, everyone. As promised in yesterday's session, I am today continuing with macroeconomics, one of the most loved and interesting part of economics. Moreover, very scoring too. If you're good and you're confident about this part of economics, you should be ready to score 40 out of 40. So today I'm going to start with the national income and related topics. Before I start systematic unit, I would like to introduce you some of the keywords and terms associated with this chapter. The first thing is what macroeconomics is. It is a branch of economics which deals with the problems in aggregates. Especially, it deals with the problems related to or the economy which is completely associated with the equilibrium of output and employment. As you know, that the last unit of this chapter, which draws the equilibrium, is about the aggregate demand and aggregate supply, which talks about the determination of income and employment. Now, to understand better this particular unit, we need to understand the nature of good. The two types of goods, that's final and intermediate good. Remember, children, this particular topic is very much important as it can be one marker, it can be an identified type of question, and also be a three marker for the difference between final good and intermediate good. So this particular PPT can help you for all the three questions. So what is the final good? Final good basically is of two types, that is consumer good and capital good. As you can see on your screen, consumer good and capital good. Consumer goods are those goods which are consumed by the consumer for the satisfaction of needs and wants, whereas capital goods are those goods which are used for the process of production or as a source of production. The final goods can be consumer and capital, and consumer further can be durable, semi-durable, and non-durable. Durable goods which have good longevity, which long last. Semi-durable, they do have some time period of shelf and they continue for a few years with us, whereas non-durable are also known as perishable good, which easily are destroyed. Now, if you're talking about the intermediate goods, these are the goods which are still being used up in the process of production, and they are goods which are meant for resale. As I just told you that you need to write the difference. So please note down some base points which will help you to differentiate between the final goods and intermediate. The first thing about the final good is value addition has already been done. Means we feel that no other value can be added to this, that is final good. Whereas intermediate good, value addition is still to be done. If we expect that still value addition can be done to that particular piece of work, that's intermediate good has not been identified as final good. For example, if I have a pen in my hand and I just use it for writing, I am making a use of this pen as a consumer, and I don't feel that there can be any other usage made out of this pen, means no value addition can be made in this. That is the final good. Whereas if I feel that this pen can be changed with the refill, I can use new refill into it. And this particular pen using new refill can become something new. That means value addition could be done and it's still an intermediate good. So what does it mean? That a same thing, the same thing can be final good and intermediate good at the same time depending on their usage. Then comes second thing is the final good has already crossed the boundary of production, whereas intermediate good has not crossed the boundary of production. Final goods are added up to the national income, whereas intermediate goods are never added for the calculation of national income. And the last thing, the final goods are not sold further, whereas the intermediate goods are still to be sold further. So these are the four headers which you can use to identify the difference and also to write the difference in the exam. These are the differences, as you can see on your screen. You can take a screenshot of it. It will help you a lot. As I just mentioned, the same thing can be an intermediate good and final good. So here's the last point as an example, which makes it very much clear that bread at the same time is an intermediate good and a final good. When bread is purchased by a restaurant, by a shopkeeper to be resold or to make the value addition to it, that's intermediate good. But when bread is purchased by a household as a consumer, it's a final good. The next topic is stock and flow variables. Stock variables and flow variables. That's very simple to understand. They are basically the one markers. They are again the same nature of questions as I just mentioned for the last. The variable, especially stock, is the variable which is measured at the at the particular point of time, whereas if you talk about the flow variable, is the variable which can be measured at the period of time. Therefore, stock is more static, whereas flow is dynamic. Stock does not have any kind of time flexibility, whereas flow has the time flexibility. So remember, examples there, like population of India, which is measured on 20th of March 2017, is stock, whereas the number of births during the year is flow. Better to understand that anything which can be measured at a particular point of time, for example, if I talk to you about money supply, it's not there on your screen, it is an additional example I'm giving to you, money supply. If you want to know about that, how much has been the money supply in the economy, you know this very well that money is the most liquid asset on the earth. It keeps changing every second, every nanosecond. So if you want to understand that how much of the money is being supplied in the economy, you need to know it at a particular point of time because every second it changes. So you can never measure it at the period of time or in the period of time. And if you try to measure it in the period of time, like for 1 hour, for 10 minutes, for 2 days, for 15 days, for 30 days, then your measurement can never be correct. So the things which are worth being measured at a particular point of time is a stock, whereas something which is difficult to be measured, better being measured in a period of time is a flow. For example, national income. National income is not made in a day. National income is something which is added on every hour, every day, every month, every quarterly, and then in a year, finally, it is ready. So it's a flow concept because it is dynamic concept. It keeps changing. It is flexible and it can be measured at a period of time for better understanding. So these two are very, very important from the very first chapter of this unit. Now proceeding to the next topic, that is depreciation. Depreciation is nothing but the fall in the value of the fixed assets. It can be because of time, it can be because of wear and tear, it can be because of the obsolescence. There are so many because of the technological advancement and many more. For example, typewriters are no more in use. That means their value has actually depreciated because that has been replaced with the new technology. So basically, it is also called as consumption of fixed capital. So in your numerical, you can also get depreciation with the name of consumption of fixed capital. I'm going to tell you the circular flow of income. Children, circular flow of income is of 2, 3, 4, and 5 sector model to understand. But in your syllabus, officially, it is only about the 2 sector model, where we just believe that there are only 2 sectors in the economy and the economy is closed. I repeat, as you can read the assumptions that there are only 2 sectors in the economy, which are household and the firms, and the economy is a closed economy. That means we haven't allowed any external powers in it or any external interference into it. Now, what is it? We can better understand this with the help of the next slide, which is here. The circular flow of income here is being represented with this diagram where you can see that there are only 2 sectors, which is business or firms, and the second is household. The households are also known as consumption or consumers, and the firms are also known as producers. Now, the firms produce, they provide goods and services to the household. For example, everything we consume that is provided to us by producers. Farmers give us the crop, factories and the producers give us the clothes, shoes, publishers give us the books. You can have many more things around you which is being provided to you by the producer. What in return we give them? We give them land, labor, capital, and the enterprise. That means all the factor services are given to them by us. Yes, we are the factors. Like I'm one of the factors. I'm providing and rendering my service. In the same way, somebody can be rendering the land, somebody can be rendering the capital if they have, and somebody can be taking the risk and becomes the entrepreneur. So household provides all these things, the factors to the business. So the right now what I mentioned to you, that means land, labor, capital, and entrepreneur, that is a factor services, and in return flow of the goods and services, they are types of real flow. Real flow is the flow where there is no involvement of money. And you can see in this outer circle that there is no involvement of money. But if you look at the internal circle, look at the internal circle, children, what you find over here is that there are again two firms, that is business and household. Now, what you think and find here is household is giving the consumption expenditure. Here, look at this. Look at the arrow also. That household is doing the consumption expenditure. Obviously, if you are getting something from the firms, what you give in return is, you give in return is money. You give the expenditure. That means you are giving consumption expenditures to the firms and the entrepreneurs or the investors or the producers, where in return they give you the factor payments. What are the factor payments? Wages, rents, interest, and the profits. Now, you see, when it is about the payments or it is about the expenditure, it means it involves money. So the internal circle is talking about the money flow. I repeat, it is talking about the money flow, whereas the outer circle is talking about the real flow. The outer one is talking about this real flow. Fine. So you need to remember that when you are writing or speaking about the circular flow of income, you need to talk about both of them. That means the real and the money flow at the same time. Irrespective of you have been asked or not, you have to make it. As this been explained in the same way I have explained it to you. Now, coming to the next topic, which is the residents of a country. See, there are two types of residents we talk about, normal residents and non-residents. That means a resident of India and non-resident of India. So what is the difference basically? Basically, the difference is all about the citizenship, of course. You know that if somebody is living in a country and has got the citizenship, is the normal resident of that place. But on the other hand, if the person is living in a particular place and hasn't got the citizenship of that particular place and belongs to somewhere else, is known as non-resident of that particular place. But here we are not talking politically, we are actually talking about the financial or economic prospect. So it's better to say that a normal resident are those individual or those people who reside in the country for more than 1 year and their economic interest also lie in that particular country. These two keywords are compulsory to be written. If you write these two keywords, the examiner will understand that you know the meaning. I repeat, the normal residents are those individuals whose economic interest lies in that particular country and they have been living there for more than 1 year. Whereas the non-residents are those people who do not live in that particular place for more than 1 year and their economic interest never lies in that particular country. Now, I would here give you the example. If a particular, excuse me, if there is a particular visitor coming to India to see the Taj Mahal, or a political delegation coming to India to visit the capital of our country, Or if a student is coming in India to learn yoga and learn Sanskrit, or if somebody is coming here in Kerala to get naturopathy and get treated by Ayurveda, they're all the non-residents of India because they are not here for economic interest. They are here for a very short period of time. Even if they are living for more than a year, like a student is completing the course for 5 years, but not having any economic interest in this country is the non-resident of this country. But if a person coming in India and starts living here, pays taxes to the government, has all the economic interest, his earning is also reinvested into this country only, then that person is known as the normal resident. Okay, suppose a Russian family comes to India and then they are settled into India itself, and they have started earning for India. They have started paying tax to the government of India. That is all known as to be the normal resident of India for that Russian family. I hope it is clear to you. If any doubt, please contact me in the end of this session. Otherwise, in some other session to talk about the doubts. Now, a very, very important thing, that is domestic territory. See, until all these basic points are clear to you, you cannot identify whether a particular set should be included into national income or not. So it sounds very simple, but they have depth in them. Domestic territory, generally it sounds about the political map, which you have learnt in your childhood, that any political boundary which is talking about, or any political map which is talking about the political boundaries of India, right from Kashmir to Kanyakumari or from Arunachal Pradesh to Gujarat, is India. Yes, politically, yes. And they are Indian domestic territory only. But when it comes to economics, this concept becomes broader. It's not all about the within the domestic territory or the borders of the country. It is also about the ships, the aircrafts, which are owned and operated by the normal residents of the country, like fishing boats, oil rigs, floating platforms, any other thing which is within the water body, that means ocean, for example Indian Ocean, Bay of Bengal, till certain nautical miles in these oceans and seas, India claims its ownership. So within that ownership, if we are having anything in it, for example, our fishing boats, our oil rigs, our natural gas rigs, floating platforms, maybe the security executions, they are all the part of the Indian economy because they are within our domestic territory. Because the domestic territory is a place where all the economic interest is confined to India only. Now, a very interesting thing, the embassies, the consulates, the military establishment of any country, which is maybe, of course, located abroad, like Indian embassy in Russia, Indian embassy in USA, USA embassy in India or Japan, Japan embassy in Pakistan. You must be feeling that why ma'am is talking about so many of embassies. I'm just talking about all these embassies because they are definitely established beyond the political boundaries of their country. In fact, embassies are always set up abroad. If an Indian embassy in Japan, it will not serve the interest of Japan. It will definitely think of the economic interest of India. So, being in Japan's political boundary, it will definitely be known as India's domestic territory only because it is serving the economic interest of India. So, the consulates, the military establishments, the embassies, everything is associated with domestic territory. Not only this, I would like to add one more thing. It's not all about air, land, and it's not only about the water and land, it is also about the air. Even in air, till certain miles, we claim our ownership. Nothing can fly without our permission in that region. So, the region where we claim our ownership, we claim our sovereignty, nobody can interfere and intervene. That is also the domestic territory of India itself. So our flights can easily fly over. We don't have to pay charges. We don't have to take permission. Whereas if you are over the air, region of any other country, you need to take permission of that particular country to pass. That's not your domestic territory. Now, some basic concepts. Some more basic concepts. That is net indirect taxes, which I'll tell you in the next PP. That is more interesting. Here I tell you the factor income, the transfer income difference. You can see the screen. Please take a screenshot quickly so that you can write if difference been asked. The factor income is the earned income. I repeat, the factor income is the earned income. Whereas if you talk about the transfer income, they are unearned income. They have not been earned. They do not have any liability in return, whereas factor income have the liabilities. Now, when it comes to factor income, they are the parts of national income, but when it comes to transfer income, they do not have any kind of inclusion to the national income. For example, rent, wages, interest, all these factor income are the part of national income. Whereas if you talk about scholarships, which are given by the government to the bright students and needy students, unemployment allowances, old age pension, orphanage funds, all these do not have any kind of obligations against. So when we do not have any kind of obligation and liability, when we do not expect anything in return, that is known as transfer income. So these are all transfer income, and always remember such things are never added to national income. Remember one more thing I would like to add. This is actually a serious thing to be listened about. See, there are two types of pension. One is the retirement pension and the other is old age pension. When one is receiving the pension after retirement, that will be a part of national income. Why? Because that is being given against the factors services. Like if I work for 60 years and after 60 years, I receive the old age pension after retirement. It must be mentioned retirement pension. So if I'm receiving anything after retirement, that is all against the 60 years work I have done as a factor. So that's a factor income that has to be added in national income. Whereas if you talk about the old age pension, which is given by the government on the name of social welfare to any random old age people, that's not a factor income. That is a transfer income. So this is a very basic and very minute difference where the children generally commit mistake, and it is very much there in the sample paper this year. So please keep it in mind. Now, the national income and related aggregates. I will now go ahead with the various national income and related aggregates with the various inputs and how are they converted from one to the other. The first, actually, there were basically 12 national income and related aggregates, but 4 have been omitted from your syllabus. So here I'll just talk about the 8 complete national income and aggregates. The first is gross domestic product at market price. It is the market value of all the final goods and services produced within the domestic territory of a country during a year. Whereas if you talk about the gross domestic product at factor cost, it is the money value of all the goods and services produced within the domestic territory of a country. Then comes his net domestic product. I just told you about the gross domestic product. Now I'm going to tell you the net. It is the market value of all the final goods and services, which does not include the depreciation. So it is net because it doesn't include depreciation. And if you talk about the net domestic product at factor cost, it is about the money value or money final value, which does not include the depreciation. Children, earlier, these definitions were not of that significance because they were never asked. But for last 2 years, I can see the definition is also becoming important. I have seen that the question papers include the domestic product definition in them. So please do prepare yourself for it. Now, gross national product. As I just told you, the net is the part which does not include depreciation. In the same way, gross is the part which includes depreciation. How it becomes and how it works, that I'll tell you in the later part. Then comes this national product. How is the domestic income different from the national income? This is only different because when you're talking about domestic income, you're talking about the income produced within the country. Whereas if you talk about the national product, you're not only talking about the produce within the domestic territory, but also you are including the non-residents income. I repeat, the non-residents income. So it becomes national income. Now, I will proceed to the next slide, which can make you the conversion of these aggregates understand better. Children, remember that conversion of these aggregates is very, very important because this has been very commonly asked in the examination, and especially when you need to convert one from the other, calculating the national income. So first of all, let me tell you how is the gross concept different from the net concept, which I was telling in the previous slide. But this time I would like to tell you in detail and particularly about the difference between the gross and the net concept. When it is about the difference between the gross and net, gross includes the value of depreciation. I repeat, gross includes the value of depreciation. It includes the value of depreciation. Whereas when you talk about net, it does not include the value of depreciation. It does not include the value of depreciation. So when you have to convert gross into net or net into gross, because there are total 8 aggregates, out of them, the 2 basically are about the gross and net. So when you have to convert gross into net, gross minus depreciation is equal to net, and net plus depreciation becomes gross. I repeat, gross minus depreciation becomes net, and net plus depreciation becomes gross. So you just remember this. If you wish, you can note it down so that it can come to your mind when you're solving. And moreover, this flow will be very much helpful to you when you are writing this. Then comes the basic difference between domestic and national. Domestic is within the domestic territory, and national is something beyond the national, domestic territory. So when you're talking about domestic and national, you actually talk about NFIFA. NFIFA, that is net factor income from abroad, and something more I'll just tell you. What is NFIA? First, let us understand. NFIA is the net factor income from abroad. I repeat, net factor income from abroad. Please note it down. Now, what is this net factor income from abroad? Net factor income from abroad is something which helps us to convert the domestic into national and helps also to convert national into domestic. But how do we find this NFIA value? NFIA value is never given directly. Here in the screen, you can see that NFIA is equal to factor income earned by our residents from abroad and factor income earned by the non-residents within the country. So to make it simple and easy to remember, because see, this complicated statement cannot remain with you in your brain when you're writing the exam. So to make it easy and feasible, remember NFIA is equal to factor income from abroad, NFIFA. I guide my students for FIFA, that is factor income from abroad. So it is easy to remember on the name of FIFA and easy to call as well. Whereas if you talk about the factor income earned by the non-residents within the country, that is factor income to abroad. I repeat, it is about the factor income to abroad. So factor income to abroad is FITA. So when you are using FIFA minus FITA, that means you get the value of NFI. Basically, anything which you earned from the rest of the world and anything you gave to the rest of the world, you need the difference. And that difference is the net factor income from abroad. And NFIA helps us to calculate domestic and national concepts, as domestic plus NFIA is equal to national, and national minus NFIA becomes domestic. So this is how we practice about domestic and national concepts. For example, if you have to convert GDP into GNP, that means gross domestic product into gross national product. You need this. Then comes is the difference between market price and factor cost. You must have seen GDP at MP, GDP at FC. At this stage, you are very much aware of it. What is MP and what is FC? Even then, I would like to introduce this to you. MP refers to the market price. That means anything's market value. Whereas if you talk about factor cost, it just talks about the factor value. For example, for manufacturing of a pen in a factory, it costs us 10 rupees, including all the factors, that is land, labor, capital, entrepreneurship, management, everything. It takes 10 rupees. Now, when it comes to market, it adds many more costs, like it adds sometimes the taxes, GST. So suppose the pen has 1 rupee of GST on it. So the market price will be 11, whereas factor cost for the pen will remain 10 rupees, because the market price is all about including the taxes. And factor cost is all about the pure production cost, including profit. So conversion from MP to FC or FC to MP, we need two things. We need subsidies and we need indirect taxes. You know this very well, that why we need them. Indirect taxes, which are paid to the government, and subsidy, which we receive from the government. So having both the things means what you paid to the government and what you received from the government, you need to make a proper and pure different calculation. That means if you paid to the government 10 rupees and you received from the government as 5 rupees, that means net you paid to the government is only 5 rupees. So that particular net value has to be added to convert the factor price into the market price. Therefore, we actually need net indirect taxes. I repeat, we need net indirect taxes. So net indirect taxes means indirect tax minus subsidies. That means excluding subsidies, whatever taxes you have paid, they will be called as net indirect taxes, which help us to convert market price into FC or FC into MP. That means MP minus NIT is equal to FC and FC plus NIT is equal to MP. Please note it down, and please note it down in the way and the flow it has been written over here. It is very, very important. And you can also take the screenshot. So let me revise once with you that I basically taught you the concepts of gross, net, which is made with the help of depreciation. Gross minus depreciation is equal to net. Net plus depreciation is equal to gross. MP minus NIT is equal to factor cost, and factor cost plus NIT is equal to market price. Domestic plus NFI is national income, and national income minus NFI becomes domestic income. So these are the basic conversions from one aggregate to the other aggregate. I hope this much is clear to you. We basically have talked about many major topics today, including and comprising of the chapter 1, chapter 2 of this unit. Now it's better to practice. I would just show you a numerical which helps you to understand how the aggregates are converted from one to the other. On the basis of the following data, calculate GNP at market price. I repeat, GNP at market price. We know this very well. We learned in the last slide that conversion from one aggregate to other. Now, let me help you in this first. How do we do it? What is the process? How do we start? This is very basic. This is ABC of this numerical. GNP stands for Gross National Product at Market Price. I repeat, Gross National Product at Market Price. So you need to find out GNP with the help of GDP. Now let us see what is the difference. Here G and G are common, but D and N are not common. P and P are common, and MP and MP are common, right? So what is the difference between that? Difference only we have to find is between domestic and national, because this D stands for domestic and this N stands for national. And if you remember, we learned in the last slide that converting domestic into national or national into domestic, we need NFIA. So NFIA is the second component given in this numerical. So you are intelligent enough to know that when you have GDP at MP to find, please add NFIA to GNP at MP, which is 50720 plus 2400 is equal to 53120 crores. This is just the ABC of such numerical. There are many more questions, but I'd like to proceed with this understanding that you are clear with conversion concepts of national income and aggregates. Now, the detailed conversion, we cannot take it lightly. GDP, GNP, NNP, and NDP kind of concepts cannot be taken lightly, as these are the basics. If you don't know this basic, you cannot find the correct value of national income. So first of all, GDP. GDP are of two types. That is, one of them is MP and the other is at FC. So when it is about GDP at MP, it means you are talking about the GDP at market price, which includes the value of NIT I just showed you. When it is about GDP at FC, it is not talking about the value of NIT. So when you have to have GDP at MP and you want to convert it into FC, you just need to subtract NIT as just discussed. And I told you that NIT is equal to indirect tax minus subsidy. Now coming to the next two aggregates, NDP. See, basic is always GDP. Basic you will always get is GDP. And now if you have to convert GDP into NDP, that means the basic difference you get is of gross and net. For conversion from gross to net and net to gross is depreciation. So getting net value can again be of two types, that is factor cost and marginal market price. So here you have the four aggregates with you. Then comes is the next two sets, which is gross national product. See, we have jumped from domestic to national, but this time we are only in gross. So if you see, the basic difference between these two is D and N, which is basically because of domestic and national. So what you need to do is domestic plus NFI is equal to GNP, and if you see that it is in factor cost, remains in factor cost. If it is in MP, market price remains in MP, that is market price, until any changes done to the NIT. NFI I have already explained to you. Now comes the final thing. Why basically I opened this. There is a bonus point for you. See, generally in numerical, you are asked to calculate domestic income. Children, whenever you are asked to calculate domestic income, remember that NDP is the domestic income. Whenever you're asked to calculate domestic income, don't think about GDP. Children generally commit this mistake by calculating GDP for domestic income. Whereas when you are being talked about NDP, you are actually talking about domestic income. And NDP at FC is the purest domestic income. So you need to talk about NDP at FC when you're talking about the domestic income. Whereas if you talk about NNP is the final destination for the aggregates, that's the national income. I repeat, NNP is the national income, specifically NNP at FC. As NDP at FC is the domestic income, in the same way, NNP at FC is the national income. I once again go through this because I have seen my students committing this mistake very often, that NDP at FC is the domestic income. If you're asked, you just close your eyes to understand that it is all about the NDP and FC. And if it is being asked about national income, just remember that it is about the NNP at FC. So these are the basic aggregates, 8 aggregates. Just take a quick screenshot and just take a note of it, that these 8 aggregates are there which you are going to deal in. Now, next and a very important thing, that is nominal and real GDP. There are various types of GDP which are calculated, but in your syllabus, we will just talk about nominal and real GDP. What is nominal GDP? Or what is real GDP can be a question with their differences, and also one more question which is asked, that which one is better and why. So nominal GDP is the GDP where we take the current prices into consideration for the estimation of GDP. I repeat, where we take the estimation of current prices. That means if you're talking about the GDP of 2020, that means you are considering the prices of 2020 only for estimation of national income or GDP. That's why it is known as current year prices as well, or GDP at current year prices as well, because it is measured with the help of the current price. So to find out nominal GDP, we generally multiply the quantity with the current price. P1, you remember index number you studied in class 11th, P1, that is the current year price. Now comes is the real GDP. Real GDP is something which talks about the GDP which is measured at the constant prices, or I must say that they are measured at the base year prices. I repeat, they are measured at the base year prices or constant prices. Now, what are the base year prices? Going back to index number, you learned that any past year which is taken into consideration can be the base year. Generally, the government of India fixes a base year which is very much constant, which does not have any flexibility. So that particular base year is taken into consideration for the price estimation of the GDP, and such estimation is known as real GDP. So here we multiply the quantity with the base year price. Q into P0. P0 is the base year price, and this is what is known as the real GDP. Now, which is better? Of course, real GDP is better. It is considered to be better. Why? Because it is not affected by inflation, or it is not affected by the changes in the price. Real GDP is the real indicator of development or growth. It reflects the real changes or real picture of the changes in the output. While if you talk about the nominal GDP, they can show the changes which have been caused due to rise in the price, or they have been caused because of inflation. You can better relate it because you are very much done with these all topics in previous class, that is class 11th. Now, if you see real GDP, how do we calculate? We calculated GDP at current price divided by price index into 100. Nominal GDP, that is real GDP, into price index by 100. Price index, if I take you to the past, that is all about the index number, P1 upon P0 into 100. That's a very, very important thing. Now, there's a question which is generally asked about GDP and welfare. When you're talking about the GDP and welfare, it is generally a question mark whether GDP is associated with welfare or not. So there are certain things which you need to mention, that yes, it is sometimes and sometimes it does not. Like GDP is associated with welfare as higher is the income or higher is the GDP, the higher will be the per capita income, the higher will be the employment, and higher will be the living standards of people. Yes, it is a positive contribution. In fact, that is why everybody is aspiring to have higher GDP for a nation, because it provides a lot of welfare to the society, whereas sometimes it has some negative outcome as well, especially when there is unequitable distribution of resources, when the rich become richer and the poor become poorer. It also talks about the welfare, but the word welfare does not only come from money. It is also associated with many more things like quality, the eradication of disparities, and many more things. So income does not resolve the social issues and problems. Definitely, GDP does not think and talk about all these issues. So it does not always bring the welfare to the economy. Like if you talk about Bhutan's economy simply claims with very low GDP growth, they claim that we are the happiest country in the world with their own happiness index. It's all because they believe that we have a lot of other welfare related conditions for the people living in Bhutan. Other than that, one more thing is which is externality. I repeat, externality. Look at this. There, it's written in the bold. It can be the one marker as well, children. I remember um, there's so many things which we can relate to our surroundings. Sometimes we are not directly involved into it, but we are affected. Sometimes we are positively affected, whereas sometimes we are negatively affected. So simply, if being involved into anything or being involved into any activity, if you're affected positively, that's positive externality. Whereas if you are affected negatively, it is negative externality. These negative and positive externalities are very, very much asked questions in the exam. You can also be asked about some of the good examples of good and bad externalities. That means the relevant examples which you need to write about it. I give you one example, which is very personal but very interesting. In my courtyard, I have some trees which definitely please me. But in my neighborhood, they have a tree which is generally called as Rajnigandha. You must have heard of or might not have heard, but its flowers smell very nice. When I move in my corridor, I am pleased more with the fragrance of those flowers which have not been grown by me. In fact, my own flowers cannot please me as much as my neighbor's plant's flower can do. What is this? I haven't put any effort into it, but even then I'm being affected, and that too positively. This is an example of positive externality. Whereas during certain festivals, there's loud music played around in the society, in the background, which disturbs me a lot. What is this? I haven't done anything wrong, but I may have to pay the compensation. I may have to pay penalty. I may have to bear the pain. What is that? That is negative externality. In the same way, in the economy also, there are certain people who are not involved, but they suffer. For example, we are not every time responsible for the air pollution, but we are a part of it. That is the negative externality. And we are not definitely every time the part of the social welfare schemes, but we are directly or indirectly being affected by this. This is positive externality. So remember, this is a very, very positive thing to understand about your marks, your grades. So please read them carefully about the GDP and welfare, their positive and negative effects both. Now is the last concept that is about the green GDP. I've not written anything much about it, just the PPT, although it's not there very much there in your direct syllabus, but it is generally asked, what is green GDP or green GNP? Nowadays, when the government of any country is making its budget or estimating the expenditure and revenue, excuse me. So when the government of any country is making the budget or estimating its revenue, they're also talking about the cost and the expenditure. So earlier what used to happen is we just talked about the direct expenditure and cost. Whereas today, when we are talking about the cost and expenditure, not only the incurred cost directly, but also the cost which has been associated to the damage to nature we have made. For example, construction of road. For construction of road, if the total budget is of 100 crores, meanwhile, if we have damaged some of the trees which we need to replenish, which we need to replant, or we need to replace them, in this situation, whatever the additional cost we are going to incur into will be the part of the green GDP or green GNP. Remember, this is definitely not directly there in the syllabus, but they are often asked in the question paper. That's it. We have covered the major two topics of this unit. I hope this class was helpful to you. See you tomorrow to understand the various methods of measurement of national income. That means the national income measured with the help of income method, value added method, and expenditure method and their numericals.